This is Jessica Dunn. We're going to continue our capital budgeting discussion, and we're going to discuss why projects have conflicting rankings. So conflicting rankings are where we see that a project would be ranked higher or lower when comparing net present value or internal rate of return. Now, these conflicting rankings occur because we see differences in the magnitude of cash flows as well as the timing of cash flows. One underlying cause of conflicting rankings is that net present value and internal rate of return treat those intermediate cash flows differently. So when you're receiving cash flows throughout the project's life, they're treating those cash flows differently. Net present value assumes that all intermediate cash flows are reinvested at the cost of capital, whereas internal rate of return assumes that they are reinvested at the internal rate of return. Now the problem with that is that the internal rate of return for the project you've chosen, that was the best project that was available at the time. So that project may have a much higher IRR than any current project. So making that reinvestment rate assumption could be problematic. Another reason why they provide conflicting rankings is to do with the timing of the cash flows and the magnitude. If the project's cash flows occur early in its life, then net present value will not be very sensitive to the discount rate. The net present value of projects with cash flows that arrive later will fluctuate more as the discount rate changes. The differences in the timing of cash flows between the two projects does not affect the ranking provided by the IRR method. So if we were to look at a couple of projects here, we have project A and B, the same projects we've been looking at. And we saw when we talked about um, the net present value profile and the crossover rate, we said that above 10.72%, project A was better, and below and greater than 10.72%, project B was better. And we see that these two projects have different rankings as well. IRR says project B is better, and project A is better according to net present value if the cost of capital is less than 10.72%, and project B is better if the discount rate is greater than 10.72%. So these differences occur due to size differences and timing differences. Smaller projects free up money for different investments. So the higher the opportunity cost, the more valuable these funds are. So high cost of capital prefers small projects. Timing differences also matter. Projects with faster payback period provides more cash flows in the early years for reinvestment. So if the cost of capital is high, early cash flows are especially good. On a purely theoretical basis, net present value is a better approach. That's because it's measuring how much wealth a project creates or destroys if the net present value is negative. And there may be multiple internal rates of return if there are non-conventional cash flow patterns. Lots of managers prefer to use internal rate of return because it does allow you to skip a step. When you're the manager of a division, you could look at projects and evaluate them based on the cash flows that you expect them to receive, and you don't have to have any idea how much the cost of financing is. You could just pass on the internal rate of return you calculated to your superiors. They could look at the cost of financing and make a decision based on that. So it does allow you to skip some steps and to look at different ways of financing projects, and allows you to pass the buck on. Scale problems occur when the projects are very different in terms of the initial cost. If there are large differences in scale, the projects are going to be ranked differently. The internal rate of return approach favors small projects with high returns, so a $2 loan that turns into 3. The net present value approach favors the investment that makes the investor the most money. So if you invested $1,000 and had 1,100 in the next day. So what do companies actually use? Whenever they were surveyed, the most popular approaches were IRR and NPV. They were pretty equal in terms of usage. These techniques are employed by larger firms to evaluate large projects. They're not really highly used by smaller companies.